Welcome all to this webinar session of Embassy Office Parks REIT. And we are delighted to have the management team of Embassy REIT. We have with us Mr. Mike Holland, who is the CEO of Embassy Office Parks REIT. And he has 20 years of experience in Indian commercial real estate. And he had played instrumental role in setting up JLL's business in India and had been running this portfolio for a number of years. Along with Mr. Mike Holland, we also have Mr. Arvind Maya. Mr. Arvind Maya is the CFO of Embassy REITs, and he is an ex KPMG and also the REIT auditor. Welcome, Mr. Maya. And we also have Mr. Ritvik Bhattacharjee, who is head of investor relations, and he also is an ex investment banker with global REIT capital markets experience. He has helped the overall to build the overall ecosystem of the REITs in India and the structures. And Mr. Banerjee is joined by Ms. Sakshi Garg, who also is in the investor relations team. She is an ex-investment banker. She was an ex-investment banker at Goldman Sachs. So we have the full management team of Embassy REITs with us. Will be taking us through this exciting and insightful session. So with all this, Mike, I'll request you to open the session.
So on your screen, so hey, welcome. Thank you very much. I see there's 116 people attending. Thank you for your time. I'm Mike Holland, responsible for Embassy Office Parks REIT. You'll see on the screen a number of slides. The intention is that we'll run through these very quickly with the idea that by the end of this session, you should be able to understand what is a REIT, a little bit more about Embassy REIT, the performance that we've had over the past year since we listed in April of 19, the characteristics both of our portfolio and the industry and the performance thereon. And we'll try to allow plenty of time for Q&A at the end. So on the slide number 3, if we could just pull that up onto the screen so people can see that. We'll start right at the beginning. REIT, it stands for Real Estate Investment Trust. It's a trust that owns, operates, and finances income-producing real estate. So very important to understand that our portfolio is an income-producing portfolio. It's not primarily a development portfolio, and I'll show you some slides a little later that illustrate that. It's a tax-efficient vehicle. So dividend distributions from the REIT in India are tax-free. We'll go through the tax structure of the distributions a little later. Maybe Arvind Maya, our CFO, can talk us through that. But the beauty of the REIT, it allows investors to effectively buy a fractional ownership in a pool of high-quality real estate assets. It's not a new investment medium. It's been around since the 60s in the US. It really has taken off since the last 10 to 15 years in the UK, in Australia, in Singapore, Hong Kong, and so on. And now last year, the first REIT here in India, and probably more to come in the future. But it gives investors able to demonstrate this as we go through the deck. It gives investors the ability to invest in high quality real estate while still having the liquidity that is often lacking in real estate investments. It gives diversification, and it gives a great mix of the distributions, dividends, as well as the potential for underlying growth. The REIT regs in India require us to pay out at least 90% of our distributable cash flows on a 6-monthly basis. We actually do that on a quarterly basis. The regs require that 80% of our asset base is completed and income producing. So again, I underline, we're not a developer, and that of course means a reduction in overall risk for the investors. On the next slide, you would see slide 4 shows effectively what the Embassy REIT structure looks like. So at the bottom, you see 11 different assets. Each one of those represents an office or a business park, SPV, you'll see that at the top there, the two sponsors are Blackstone and Embassy, both of which I think if you're based here in India and active in the investment market, you'll know those. 30% of the REIT is held by the public at present. It is managed by, you see on the right-hand side there, EOPMSL is the manager to the REIT. So I and my colleagues who are on the call today are responsible and for that management, and we're part of that manager. We own all of the assets underneath 100% with one exception. We can talk about that later if anybody has a question on that. But fundamentally, the rental from those 11 assets at the bottom moves up to the REIT and then is distributed on a quarterly basis for us as those distributions that we spoke about. So investors, those public unit holders, currently 30% of the trust, receive their share of those distributions on a quarterly basis. Next slide, on slide 5, gives you a feel for our portfolio. So you can see on the right in the chart, we've got a high focus around Bangalore, nearly 2/3 of the portfolio down in Bangalore. And that's because Bangalore, as I'm sure you all know, is very strong in the technology sector, many global and international tenants. The portfolio as a whole is approximately 33 million square feet. That includes just a little under 8 million square feet of potential, what we call on-campus development. I'll show you a little of that in a while. At the bottom right there, you see that our revenues for last financial year, 2,145 crores. That is what was converted into the 1882 crore distributions for the last financial year. And those distributions, as I mentioned, come from the rental, which come from those 160 blue chip occupiers that we have. 42% of those occupiers are Fortune 500 companies. So really strong covenant from those tenants on long-term contracts, that's 7 years weighted average lease expiry. So that's the overall portfolio. There's three, on the next slide, there are three characteristics that I'd just like to highlight that are very important to understand about the REIT. So as I mentioned, if you see on the left-hand side, we're a commercial office portfolio. 91% of our income comes from the office component. The balance is actually a solar park, which provides renewable energy to the offices, and a small proportion of hotels which are on campus. We'll show you those a little later. So no residential. This was one thing that we often had to highlight when we were in the pre-IPO process. We're not a developer. You can see that from the middle section, 90% of the portfolio are completed assets with that 33,000 crore asset value, 90% of that completed. The balance is that on-campus development. And on the right-hand side, another unique aspect of Embassy REIT is the very strong balance sheet. That total enterprise value of 32,000 crores, net debt approximately 15%. So when you compare that with a typical developer and or REIT actually outside of this country who would have net debt to TEV that may be in the 30 to 40% range, we compare very strongly and very favorably. That gives us a lot of dry powder for acquisitions, but it also gives us a lot of resilience in challenging times such as these. Our tenant base, if we move to slide 7, our tenant base is really founded upon the tech sector and more specifically around these global capability centers from international companies. The NASCOM industries, as I refer to them, employ over 4 million people here in India. And what we've seen over the last decade is the sophistication of the tasks that are being carried out by those companies across many centers in India has increased dramatically. And so if we look at the right-hand side of that slide, at the top right where we see services, so BPM, IT-enabled services, that is something that as the world has become more complex in the tech space, we've moved along this value chain, looking down through that creation of software, addressing the issues of cybersecurity, e-commerce, which of course is doing extremely well at present in the current climate globally, digital payments, the move to cloud, the digitization of businesses. All of these types of activities are being serviced by our types of tenants here in India. And one of the common questions that we used to get in the last year is, are we over-reliant on the tech sector? Are we overly focused around Bangalore? And in fact, in times such as this, when there are challenges arising from the pandemic, this tech sector actually is one of the sectors, if not the sector, which is prospering the most through these difficult times. And so we're in the right sector and the right locations, catering to sophisticated global companies in that space. On the next slide, you can see some of those companies, the type of tenants that we have in the portfolio who are paying those monthly rentals on those long-term contracts. And you see on the left-hand side of that circle, 50% of our portfolio are in that technology space. Globally recognized names that we all know, the Googles and Facebooks of this world, Microsoft. Those are our core technology type of tenants, as well as strong Indian technology companies. L&T, Infotech is there. They're doing things like working on for overseas companies, but on software and technology for new electric vehicles, for example. The second largest segment that we cater to in the financial services, large global banks like JP Morgan, companies like Wells Fargo, companies like DBS Bank, all within our portfolio. We've got in the retail segment, I'll just highlight that as 7%. That's not what we call bricks and mortar retail. That is companies that are supporting international retail, companies like Lowe's and Target, who are supporting the omni-channel retail aspects of their business, doing digital, doing data analytics, doing e-commerce out of our parks here in India. Healthcare companies like US companies like Cerner, MetLife in the insurance space, and so on. All these companies are here in India. It's no longer primarily because of cost. The number one reason, and this is widely accepted and understood, the number one factor that brings those companies here to rent premises from us is the human capital that India can offer in the technology space. So it's the people and their skills that are available here at scale, which is not the case, particularly in the West. So it's not primarily about cost. And if we look at the next slide, you can see the conversations about rentals. You can see why it is not about the rental of my office space here in India that will make or break a decision as to whether or not those corporations are here in India. If you look at your typical Bangalore, NCR, Pune type of office rental, these are CBRE numbers, Those are US dollars per square foot per year. You can see that our rentals are a third of those in LA, for example. They're a quarter of those in San Francisco and New York. They're 1/7 of the rentals in Singapore and Beijing, and 1/10 of those in central London. So we have two takeaways from that. One, we believe there's plenty of room for growth in rentals as we look forward, because these corporations are primarily here to look at high quality talent, and attracting and retaining that talent. They want to provide those people with a high quality workplace. So companies are more focused on the qualitative aspects of the premises that we provide, and not so much on the quantitative aspect of rental. So we're in a great place on that. We'll skip forward a couple of slides to slide 11, on which you can see a number of elements of, the next slide. Highlights for our last financial year. So we closed the financial year and announced our results in the middle of May, about a month back. The important part for our investors, you'll see in the right-hand blue box there, we distributed in the full year 1882 crores. For overseas investors, that's 250 million US over the 4 quarters of the year. At our listing price, that equated to approximately 8% yield against our listing price, and a total return for the year of 25%. We'll break that down in a couple of minutes. We build that distribution on a number of platforms. So we lease new space. You can see there that we leased 2.4 million square feet to 25 new occupiers across the portfolio. We released existing space at a premium, and we renewed existing leases with a mark-to-market, and we'll show you that. We also delivered on-campus development, 1.4 million square feet. We'll show you some pictures of that. And we worked in an active asset management capacity to achieve our contracted escalations and deliver the overall returns shown there on the right-hand side. I'll jump straight to, we'll go past number 12, which is a variation on the same theme in terms of revenues, NOIs. You see that 15% growth in NOIs. On the next slide, we'll just show you how we achieved that growth. So on slide 13, that 15% growth in NOI, you can see there breaks into four categories. The first category is the contracted revenue. Now, I think most people on this call may be from the Indian market, and so will be familiar with the types of lease structure that we have in India. There is a difference between the leases outside of Bombay. Bombay tends to be a 3+3+3 year lease structure. Bombay represents about 15% of our overall portfolio, as you saw before. So the other markets that we're in, the typical lease structure is a 5+5 year lease term, sometimes with a third 5 year. And in that lease, there is a 15% escalation contracted every 3 years. And so what you see in that first bucket, that 117 crore additional contracted revenue, which is 48% of the increase in our NOI, comes from that contracted growth within the portfolio. So here you're seeing, your income, your base income from your rental, and now you're getting that extra 117 crores from that contractual escalation. The next component of growth is as we lease up vacant space in the portfolio. Today, the portfolio is running at approximately 93% occupancy. So there's 7% occupancy there. So as we lease up that vacant space, that generates new rental income. And as leases come to an end and we bring those leases up to market, and we'll show you approximately that's a 30% uptick on the mark to market, we generate more additional NOI. So here last year that was 113 crores additional. So the majority of our growth from last year was from those two, contracted and vacancy lease up. We also added at the end of the year the new premises to our portfolio. The rental for that did not yet fall into last financial year. We'll see that in this financial year. So what you see there, that 7% development, that 18 crores, is for a building that we finished at the beginning of the previous financial year. That additional 18 crores of rental. And of course, this year we'll get full year rental on that. And then we opened one of our two operating hotels, which was under stabilization, and that added a little bit of additional rental income. So you put those together, that's how we get to our 15% growth for last year. And actually, these numbers align very much with the numbers which were there in our original IPO prospectus. So very predictable overall numbers. How does that performance compare with both alternative investment stocks and with overseas markets? We see that now on the slide on the screen. This overall 16.9 growth in our share price. So that's not the distributions, that's the share price performance for the last financial year. You can see how that compares against the Nifty 50 and against the BSE Realty. So very positive year last year against those domestic benchmarks. And then I think if you look at the real estate related benchmarks to the right internationally, Singapore REITs, that down 19.6 STI index, and then the US markets and the relative position there. So a great performance relative to those benchmarks. If we look at the next slide, which shows us how did we perform against key listed Indian real estate players, and we very deliberately not named any one of these peer group, these 10 peer groups, but you can see a very significant difference in the overall return. And so the 25% that you see on the left, that is built up from the 16.9% increase in the underlying unit price, plus the approximately 8% in distributions to make that 25. And so you see, compared to the 10 peers, significant outperformance. I was looking at this earlier on, and I think you can say there's really three factors which would account for that. One is we are an office owner, and we are not primarily an office developer. So the development risk and the risks of development in terms of time, legal title, financing and leasing, that's something which is much lower for us. So we're not in the residential sector, we're in the office sector. We're very focused on what we do. And of course, we have a very strong balance sheet, that low level of debt that I mentioned earlier on. I think if you unpack those three factors, the asset owner versus developer, the sector as office, and our balance sheet, that accounts for much of that outperformance. And then we break that down also on the next slide, 16, to show the total return of 25% on the left. And then we see at a pre-tax level, three examples of more fixed return type of instruments, the AAA bonds, the GSEC fixed deposit, and those typical returns. And then we look at what happened to the equity side in the last year. You can see how those perform. And effectively, what one is able to achieve with the REIT is perhaps the best of both worlds. From the base asset base that we're generating the rental income, we have high levels of certainty from that contracted income from those 160 largely international tenants that gives us that quarterly distribution yield. But we also have the underlying asset, the increase in value of that asset as we add new premises to the portfolio through our on-campus development and or through acquisitions, allows us to get the returns that one might get from an equity instrument, but also with the quarterly, in our case, distributions. Tax treatment is shown on the next slide. There are three categories of that make up our quarterly distributions: dividends arising, amortization of existing debt, and the dividend itself. The dividend is tax-free, and the rates that you see here are the tax on the interest component of that distribution. Perhaps we'll come back to this in the Q&A a little later. And I'll just show you a few images on slides 19, 20 of what the portfolio looks like. So if we go down to the next slide, we often talk about the total business ecosystem. So our parks are not standalone office buildings generally. The portfolio, 31 million square feet out of the 33 are these large-scale business parks. Some of you will know some of these parks in Bangalore, in Pune, in Noida. On the top left, Manyata is a 120-acre business park with largely technology tenant base. But we provide a complete business ecosystem, which includes sports zones, it would include food courts, it includes hotels, conferencing, and so on, to provide really for every need of those businesses. And then in addition to that, on the next slide, we have 4 prime city-centric offices. Many of you, I'm sure, are based in Bombay. You'll know some of these properties, of course. Express Towers, iconic building in Nariman Point, FIFC in BKC, First International Financial Centre, Embassy 247, and Embassy 1 in Bangalore, which is a mixed-use development, which also includes the Four Seasons Hotel. So that's the 11 property assets which you saw on the overall structure before. On our next slide, I just highlight the mark-to-market on our rental growth. I spoke earlier on and I showed you that bridge for the NOI that showed how we get additional rental income when our leases come up for expiry. You see that 89 rupees is the average market rental across our portfolio, whereas our in-place rentals are at 68. So when the lease expires, we're able to achieve that 30% mark to market. And that's something that we've got data to demonstrate we've delivered on in the past. You can see over the coming years, a pretty balanced level of expiry, that 1.4 million square feet this year, already in advanced discussions for about 400,000 square feet of that expiry this year, again 1.2 million square feet next year. So a consistent ability to deliver on the expiries as and when they come up. We're already negotiating on the expiry that comes up in FY23, and we're comfortable and confident of where we're at in discussing that renewal. So that's one major driver of our additional rental. On the next slide, this development pipeline, when we add new buildings to the portfolio, this is what's being shown here. So in FY20, last financial year, you can see we added that 1.4 million square feet in 2 different locations. Over the next 3 years, we'll add a further 1.9 million square feet. And I'll show you some images of that. And clearly, as we add those buildings, we add more rental and we add more value to the underlying asset base. If you look at the next slide, 23, you can see on the right-hand side, 2 of the office buildings, which were completed at the end of last year, beginning of this year. At completion, those 2 towers were 75% committed. We announced, and you'll have seen perhaps in, I think, today's Economic Times, a report about a 300,000 foot lease deal with a company called ANSR in one of those towers at rentals which are in excess of 100 rupees. So even in this challenging time, the ability, because of the product, because of that total business ecosystem, to lease up new buildings. These buildings are sitting at the front of Manyata Tech Park, that 120-acre park I mentioned. There's 45 plus corporate tenants in that park. The 2 buildings on the left-hand side, the 2 that are yet to be completed, are 2 hotels, a Hilton and a Hilton Garden Inn, with a large-scale retail and convention center. And again, we see that as catering to the whole business park, where we would normally have over 1 lakh people will be operating with those 45 corporations in Manyata. On hotels, again, just to underline, the reason we have hotels is we see them as complementary to the office. In these 3 columns on the right-hand side, you can see those 2 Hilton hotels that I just mentioned, excuse me, that are under construction. At the left-hand side, we have a Hilton at Embassy Golf Links in Bangalore, 247 rooms. Historically, a really terrific performance. Usually during the week, close to 100% occupied. Of course, over the last couple of months, those have been closed, but they've both now opened. That's the Hilton and the Four Seasons. They've both reopened, and we foresee that they'll get back to a stabilized position over the coming months. Excuse me. So just a couple of comments on the current COVID pandemic and the impact of that. I think first off, you saw earlier on, our tenant base is primarily international. It's actually 78% of the companies are international companies. 42% of those companies are Fortune 500 companies, and 50% of them are in the technology sector. So actually, as I said before, many of those companies are doing well in the current environment. We have been able to collect between 92 and 95% of our rentals. There are a number of tenants who are stressed in the current environment. They come from front of house bricks and mortar retail, which accounts for 2% of our portfolio, perhaps a little in the co-working space, a little in the hospitality, travel and tourism sector. But broadly speaking, our tenant base is in good shape. And in fact, today, approximately 16,500 people are back working in the office for over 150 companies. We're in a very strong position financially with our balance sheet, as I mentioned before. And we've had a great, actually, relationship with our tenants through this pandemic period, helping them to continue to operate in their and support their work from home. We're happy to talk about the work from home side a bit later if there's a question on that. So the other factor I think that we have to bear in mind as we went into this pandemic is that supply in the markets in which we are operating has been falling dramatically. JLL and Cushman & Wakefield both reported a 30 to 40% drop in supply of grade A office in Q1 on a year-on-year basis. We think that supply is going to continue to fall or moderate, and that will serve us well as a strong balance sheet landlord. Vacancies were already low in our key markets, Bangalore and Pune, for example, between 4 and 5.5% vacancies. So that works very well as an overall market dynamic for us. And of course, we believe that the product, that high quality product, total business ecosystem, is something that the international companies continue to want to lease. So just a final summary on slide 26. We're continuing to focus on our leasing. There will be a slower lease up over these 2 quarters. We believe that by year end, companies will be coming out of this challenging time, making decisions on de-densification, for example, that they may in fact need more space as they get less density in their office. And indeed, the technology companies, as happened at the time of the global financial crisis, may indeed have more demand for space as they have more people working out of their captive centers in India. We're continuing to deliver on our new buildings on campus. We have the advantage that we have strong funding in place and also that we can bring forward and or delay that development as we see the market evolve. We're out in the market looking at potential acquisition opportunities. Certainly the stress that's there in the market may generate new exciting opportunities. And of course, we continue to have that solid base of close to 25 million square feet of existing leases, existing companies, all paying us their rental on a monthly basis, which allows us to continue to pay that quarterly distribution as we've done in the past. So that's a very quick overview of the overall business, the performance of REITs generally, the performance of Embassy REIT in its first financial year since listing. We'd be happy to take questions. I think we've got another 15 or 20 minutes that we could take questions.
Sure.
Piyush, if you want to start with a couple of questions of yours, please feel free to go ahead or gather a couple.
Yeah, so actually we have a couple of questions coming on the Q&A slides. I'll take up the question from Mr. Ilesh Karia. Mr. Karia is asking that what is the tax applicable for individuals on repayment of NCD component?
Yeah, so can I ask Arvind to take that? Arvind Maya is our CFO.
Sure, Mike. Hi. So in relation to our distribution, let me cover all the 3 aspects so that you are pretty clear. So as Mike mentioned, there are 3 components. One is the dividend distributed, which is exempt from tax. Second is the interest on the SPV level debt, which is given by the trust to the SPVs. That is subject to tax in the hands of the unit holders at their respective tax bracket. And the amortization of the SPV debt or the repayment of SPV debt, similar to dividend, is exempt from tax in the hands of the unit holders. So, I mean, if you go back to the slide on yield computation, post-tax yield. So the way we have computed that is we have assumed tax only on the interest component. Post that, we've arrived at the post-tax returns for various investor categories. I hope that answers your question.
Yeah. Okay.
Ilesh,
And Arvind, do you have the numbers on the Q4, the proportion of dividend interest and amortization?
Yeah, so just give me about 30 seconds while I pull that up.
It's slide 11 of our quarterly deck.
Yeah, so if you were to just look at probably for the entire year, which was we distributed 24.39 rupees distribution for the whole year. Of that, 9.99 rupees was the interest component. So that is approximately about 41%. So on the entire distribution, 41% was subject to tax, and the balance 59% was exempt from tax in the hands of the unit holders.
Okay.
And Arvind, could you also explain why the dividend proportion was relatively low last year of the total distribution, and what you anticipate will happen to that over the coming year?
Sure, Mike. I think in relation to dividends, there were a couple of components. One, since this was the first year post-listing, and there was a sizable chunk of debt which was given by Reit to SPVs. This was largely coming from the IPO proceeds. So a large component of our distribution went in the form of interest and repayment of principal. But the other primary reason was one of our biggest SPV, which is Manyata, was held in a two-level structure. So just to bring the investors up to speed, what the tax rules talk about is any dividend distributed by the SPVs to the REIT, as long as they are 100% held by the REIT, are exempt in the hands of the unit holders. Since Manyata is currently held in a dual level structure, in order to optimize the post-tax returns for unit holders, we had kind of worked out an efficient split between our overall distribution for FY20. Having said that, I think one of the announcements which we made as a part of our year-end results is that we are going ahead and collapsing Manyata into a single level structure through a restructuring scheme. This scheme is of course subject to approval from NCLT and might take about 12 to 15 months more. But having said that, the dividends, as and when some of these restructuring gets done, will increase over the years.
You can see that, Piyush, if you could just show slide 4, you can see that structure there, the dual structure. So what Arvind is saying is where you have that dual layer structure, you don't have the tax benefit.
Moving on to the next question, Mr. Kanaya Tibrewal. He's asking that there is a recent news of IBM vacating 50% of the leasing across India, and they're occupying almost 12% in your properties. How do you see that happening?
Yeah, Mike Holland here. So how do I see that happening? I don't see it happening, but and nor do IBM, given the fact that they in the same report they informed the paper that published it that it was not correct and it was inaccurate. So I think if you look at the report in Mint and read what IBM said, then there were a number of inaccuracies in the original report, one of which was that the quantum of space that IBM occupy in the country. But IBM have declined, have stated that is not an accurate statement. So that's all I think that we'll say on it. We believe that IBM have said enough.
Mm-hmm. Correct. Okay, moving to the next question by Mr. P. Mehta. How are you handling situations where tenants are not wishing to honor their commercial lease rental payments due to the current situation of lockdown, and that they're seeking waivers?
Well, as I said earlier on, we've achieved 95% of our rentals for April and close to that number for May, and we'll be moving in that direction this month. Clearly rentals come in through the course of the month. So the vast majority of our tenants have already paid us. I mentioned about those 6% tenants that are in the stressed sector. We have had given some concession to the small scale vendors, particularly in the retail sector of food courts and ancillary, but they account for less than 0.5% of our overall rental income. Our position's been clear. and in fact, the same position as most of the large-scale institutional office owners in the country, is that we've kept the parks open for our corporate tenants to allow them to continue to operate and run their data centers, their servers, and so on. We've complied with our side of the contract, and vice versa. We expect them to do the same, and it would appear from the rental collections that they agree with us.
Okay.
Yeah.
So
Hey, Piyush, if I can just add to that,
Sure.
if you just maybe it's worthwhile reiterating and going back to slide number 8, where you see the quality of our tenant base. These happen to be the world's largest and most well-capitalized companies. The majority of them are public companies. They have market caps in $10 billions, if not in the hundreds of billions, and some even actually sort of at $1 trillion market cap. I think their financial positions and their ability to pay the rents that Mike alluded to in that.
Mike, there is an issue with the audio.
Yeah.
Can you hear me?
Yeah, Ritvik, now it's better.
Sorry. I think I'm just making the point that if you look at slide 8 and the tenants we have, they're the world's largest and best capitalized companies, the majority of them. So I think their ability to pay the cheap rents in India aren't in any doubt, as we show with the differential and what the rents are on that other slide. So when you have names like Facebook, MetLife, JP Morgan, Google, these are companies in the hundreds of billions, if not the $1 trillion market cap range. I think their ability to pay Indian rents is quite intact.
Yeah, that's a good point you made. And I'll move to the next question. That looks an interesting question from Mr. Akash Thakkar on de-densification. Since work from home becoming an integral part, what percentage of increase in area do you foresee in terms of expansion by the same tenants? Say currently, if they occupy say 10,000 square feet, then what increase in percentage terms do you expect in this situation?
Yeah, that's a good question. So there's two variables here, aren't there? On the one hand, there's de-densification, and on the other hand, there's more flexibility around working. I think there's a general agreement that there will be more flexibility, but that office will still remain core to the large corporations' operations. One example from a banking sector client in our portfolio, he said after they'd studied their floor plans and their densities that they could only accommodate 28% of their headcount within their existing facility as they de-densified. So if you took that extreme example, it would be between 3 and 4 times the quantum of space if they were to work 100% in the office, which I think is unlikely. We think that there will be more flexibility. But so there's a push for additional office space from de-densification, and that will be moderated somewhat by the work from home aspect. That said, our views on work from home are becoming actually what we said 6 weeks ago is becoming sort of generally accepted views from many countries and within India, that work from home is challenging from a physical infrastructure perspective, from the data side of the digital infrastructure, so privacy issues, data privacy and so on, as well as broadband, as we've just illustrated from Ritik in Chennai. But also, and probably more importantly, we think, is the issue about companies wanting to create a business culture with a young demographic of their employee base. That's something that's been spoken about by the CEOs of both Infosys and Microsoft. How do I create a business culture in a work from home environment? But there's also the issue of, from the employee's perspective, these young people at the beginning of their career, how does a company create what we refer to as the discipline of work? How does that individual create his or her learning experience that the office provides from their peer group and from their mentor? and how do those young people build their careers through networking and meeting people as well as learning from people. And that is another component where the workspace and the office, we think, will continue to be very strong. So to answer your question, that 10,000 square feet, we certainly don't see that decreasing, and potentially there may be pressure upward on that. But there's a number of variables that come into play.
So another connected question to the hotel portfolio, which looks pretty large in your overall portfolio. The question is from Mr. Jitesh Mehta, that what effect of COVID do you foresee on your hotel revenues?
Yeah, I mean, maybe we could just jump to slide 6, because you know, it's actually a very small proportion of our overall NOI. You know, less than 1% for last year. In terms of value distributions, it's less than 5% of the overall portfolio in terms of values. We have hotels because it is an ancillary amenity that supports our office space. Clearly, there will be a challenge over the coming months as those hotels get back to business, but we believe in the medium term that they will continue to support the office business parks. And that is another part of what gives us a competitive advantage in leasing to companies who want the flexibility of conferencing centers on the business parks. Companies through COVID, for example, who have been operating at our Hilton golf links for their business continuity. Even throughout the shutdown, a number of companies wanted their people to stay on the business parks in order to keep their data centers and server rooms going. And so our hotels have provided that. So it will take some time to get those hotels back to stabilization, but we see them as a strong piece of the overall total business ecosystem, but a small piece of our overall portfolio, less than 5% in terms of value, less than 1% in terms of NOI.
Yeah, I think we'll move to the next question. It's asked by Mr. Samir Shah from Calcutta. Can you give one practical example of an investor who has invested, say, before 3 years till now, how the payout sheet looks like from a time-wise perspective? I think one of your slide answers that on the returns.
The REIT, just to be clear, Piyush and Mr. Shah, the REIT was only listed as of April 1st, 2019. So unit holders, even retail unit holders, only had a chance to invest at the IPO price of 300 rupees per unit. I think, you know, if you were to take the referral point of March 31st, 2020, then you would have received a total return of approximately 25%, including the 8% of dividends, plus the close to 17% of share price appreciation. So I think that's probably the more relevant benchmark at this point in time. We weren't listed before April 2019.
Correct. So I think we just have next 2 to 3 minutes, and we'll be taking 1 or 2 last questions. I'll take up this one from Mr. Ilesh Karya. What is the status on acquisition of a ROFO asset offered by Embassy sponsor? What will be the price of acquisition?
Ritik, would you like to take that?
Yeah, sure. I think we mentioned it in our earnings call in May. For those of you who didn't listen to that, what we did say was that given the volatile markets, we have actually paused the analysis of the asset, and therefore it would be prudent of us to comment on any acquisition price or process at this stage.
Okay. So I think we are almost at the end of the session. I'll take one last question. What is the percentage of units held by Embassy and Blackstone? It's asked by Mr. Jitesh Mehta.
Yes, sure. I think just the units that are held by Embassy is approximately 15%, and Blackstone sponsor is 55%. The total holdings stand at 70% for the two sponsors.
Okay, this answers the question asked, and I think almost we have taken more than 15 questions, so it's almost the time to end this session. So thanks a lot, Mike, Ritvik, and Arvind, on giving us so much of information on REITs, which otherwise are complex instruments. But your presentation made it very simple to understand, and your portfolio is definitely grade A. And what a great exposure an investor can get in 3 or 4 different cities, which for an individual investor investing in his individual capacity in direct real estate could be difficult. That can be achieved actually by investing in these kind of an instruments, which can give exposure to multiple assets across multiple cities. And again, the highest corporate governance standards which you maintain, that makes this case a very compelling case for investments. I hope that a lot of people who look for a rental yield and continuity of these kind of returns will definitely get excited and look forward to uh, uh, invest in these kind of instruments. So I thank all the participants for your lively participation, and I again thank the embassy's management team to who have taken their precious time out to take us through this complex product. But the kind of mastery they have and the ecosystem which they have developed will pave way for the further development of more products in India. And of course, these kind of products are gaining traction. So thank you again, the embassy management team, and mm, uh, I again thank all the participants for the time they've taken out and the kind of participation which we had seen, almost like 15-20 questions. Very it happens very rarely in this kind of webinars. So thank you again for your participation, and with this note, we'll end this meeting.
Thank
Okay,
you.
thank you very much. Thanks
Thank
very much,
you.
Piyush. We'll, if there is follow-up on your end, don't hesitate to contact us. We are more than happy to respond and happy to engage with your clients in the future as well. REITs are an important part of the ecosystem for real estate, and I hope you've been able to learn something and pass it on.
Yeah, sure. We
Thank
will
you.
definitely looking forward to connect with you guys on any query we have.
Great. Thank you.
Thank you.
Thank you all.
Thank you, Piyush. Bye-bye.
Bye.